level of growth, especially, especially here within the US. And so I'm calling for growth that will be above trend, well above 2%. Potential growth of the US economy will now approach 3% in the coming years. And we have a number of drivers to spur growth higher in 2026. And we can chat about those in just a moment. But I want to highlight for the audience a structural shift that is related to the supply side that is just going to raise the inherent capacity of the US economy to grow. And this will be led by things like AI and technology leadership, productivity growth, global competitiveness, lower energy and material costs, things that just will allow the US to grow faster.
Okay, thank you. And can you talk me through some of the other drivers? Um, you listed a number of them there. Um, so can you talk in a little bit more detail about, like you said, this is a little different. We have, it's not really driven by the labor force, and we
Yeah.
also have an aging population. Can you talk a little bit about that?
Yeah, there are so many things going on. So, at a very tactical level, I'll keep the horizon short term. We had
Okay.
2025, where at least in the first half of the year, the US economy was hopelessly lopsided, right? The base of leadership was extremely narrow last year. Almost all growth came from AI spending. The consumer was especially weak, especially at the low income end of the spectrum. And the good news is in 2026, we'll have multiple drivers of growth. In addition, we'll inherit AI as a good tailwind. But in addition to that, we have fiscal stimulus from the one big beautiful bill. We know the Fed has resumed its easing cycle. So we have lower interest rates, so we have monetary stimulus. The administration has promised us a regime of deregulation. We should see some of that coming on board. But you make an interesting point, Heather, because you referred to lower level of jobs or an aging population. The hallmark of this next phase of the cycle, there is something very different than prior cycles. Normally, with US GDP growth in excess of 2%, you typically expect job growth to be something like 150 to 200,000 new jobs per month. This expansion from here on is going to be a jobless or low job growth expansion. And it comes really from two factors. You referred to one of them. We have all across the developed countries, we have adverse demographics. We have an aging population. So the labor force itself is shrinking. And then don't forget, AI is beginning to grab a foothold and it's automating jobs. So there are just fewer jobs available and fewer workers to perform them, which I think, if I can kind of anticipate a question, might just be, well, wait a minute. We know that the ability of an economy to grow has a lot to do with the size of the labor force. If it shrinks, how can I be standing here projecting, a handsome, almost 1% increase in real GDP growth? And I think that comes to the productivity growth. So the fewer workers that are left here in the US and in the developed world, they will just become more productive from this AI revolution, which really, Heather, is just gaining traction almost at a scary pace.
Yes, it is. Um, so you touched briefly on inflation. How much flexibility does the Fed have?
So, Heather, I'm not sure if we have converged to a consensus on inflation globally across the investor base. I know several people who are just worried and anxious. They just cannot shake off the fear that tariffs are not quite done yet. And because I am also talking of faster growth, shouldn't that be accompanied by higher inflation? That's the fear, right? So
Right.
in the US, most inflation metrics have just inched slightly below 3%. There are many who fear that this 3% barrier actually may not be breached meaningfully, that inflation will be stuck here at 3%, may actually even drift higher, in which scenario the Fed would have limited flexibility, right? The Fed funds rate is already at 3.5 to 3.75. And if inflation lurking with a three handle, that almost suggests that the neutral rate for the Fed is right where it is. I do have a different view, Heather. I think inflation will continue to subside, and I can dwell on maybe three or four different reasons why that may be the case.
Yes, please.
Yeah, yeah. But let's think of a destination. The Fed aspires to have a 2% inflation level in the US. They're still holding on to that as their target level. 2% may be a little hard to achieve, at least in the near term. Who knows, 4 or 5 years out. So I'm calling for inflation to subside to around 2.5%, maybe slightly below. And the reason for this optimism on inflation, let's see. Off the top of my head, I can think of. So let's start with some themes that are already on the table. We talked about fewer jobs being available. So this is disappointing for new entrants into the job market. But for
Yes.
our purpose here, it's actually encouraging because that gives workers less leverage. So it should lead to wage disinflation. Okay. I talked about higher productivity growth from AI. That also is disinflationary. You can make more output for the same level of input, right? Workers are just more productive, so you don't need as many of them. So you have wage disinflation, productivity growth. In the US, a unique aspect of our economy is that shelter. So rents that you pay to stay in an apartment or the cost of home ownership, it's a really big component of inflation. So the
Yeah.
consumer price index, I think that share is something like 35 or 40%. And shelter inflation has been going down steadily. And in fact, shelter inflation moves slowly and sluggishly, but it's very predictable. And so, yeah, there have been some data distortions with the government shutdown, but we expect that trend to continue. Um, and so you have all of these multiple drivers that I think will continue to push inflation lower, which allow me to kind of come back to your original question. So if I'm now calling for inflation to be 2.5%, the Fed can bring rates down to about 3%, right? Typically, the policy rate from the Fed is about a 0.5% above the inflation rate, which means that the Fed, now sitting above 3.5, has room for two or three more rate cuts, which is again good news for the US consumer because lower interest rates should ripple through the economy and make borrowing easier. Mortgage rates might come down a bit, and so it should be stimulative.
You touched on a point there with young people being unable to find jobs and AI perhaps making some of these lower level roles obsolete. Should we be worried at all about unemployment?
That's a fair question. And Heather, just instinctively,
Mhm.
kind of the naive human response in me says, "My God, that's terrible. It's so sad. What will people do?" But then immediately in the next sentence, with the next breath, Heather, I kind of fall back on kind of my long-standing respect and acknowledgement of human ingenuity, right? We've gone through so many revolutions. So imagine when the automobile was built, or heck, even the sewing machine, right? People who had those jobs must have feared that this is it, right? Mankind is going to come to an end. The only job I know has been automated. And we have seen we have the personal computer, and I'm optimistic that people will get retrained. There'll be some growing pains as we go through the transition, but they will find other ways to use AI now as a tool to do more value added work. And so yeah, I'm not so pessimistic. There is a dark side to AI that if left uncontrolled. So the governance, the policy implications of how to make sure that AI doesn't kind of take over all the machines and destroy this planet or mankind as we know it. That's a whole separate topic. I don't think it might be appropriate to touch on that here. There is another fear about AI. So with this is about what happens to all the jobs and what happens with mass unemployment and then a rebellion of sorts. That's one. And then the other one, a more practical, commercial, and materialistic concern, Heather, is we know how much money is being spent, right? I think all AI spending was $450 billion last year. And there are firms, right, that are have committed to $1 trillion of spending from one company alone. I won't name names here, but there is a fear that AI is already in a bubble that
Right.
valuations are so high and this is going to explode. And because it is such a big driver of the economy, people fear that this will lead to a big recession and then a big bear market and invalidate everything I've said so far. So I don't know. I'll
And
leave
so
it
do
up to
you
you.
think,
Is that of interest? Should we kind of touch on?
yes, yeah, please tell me, do you think we're in an AI spending bubble?
Okay. See, I like that. You just made it so crisp and crunchy. So I have to literally answer that in yes or no format first before I give any color. So, like a good politician, I'll say the answer is a little bit of a yes, a little bit of a no. Overall, no, we are not in an AI, what I call an AI everywhere bubble. So it's not like everywhere you can see AI is in a bubble, and I'll tell you where it is not. And luckily, it's more in mainstream AI that it is not a bubble. Having said that, there are niche segments and areas of AI that have clearly seen speculative activity. And just to suggest to you how silly some of this stuff may be. I remember distinctly in the third quarter of 2025, my goodness, we saw companies, Heather, that simply had the word quantum computing. Let's make it even sillier. They had the word drones somewhere in their mission statement, and these stocks just went on a moonshot. They went up 50, 60, 80, 100% just on the allure and the promise of AI. So watch out for small companies that have no competitive advantage, that cannot scale. Look for stocks that have already ballooned in valuation, where not the price to earnings ratio, but the price to sales ratio is over 100. Look for companies that are borrowing money to spend money. Look for companies that are spending like there is no tomorrow in the hope of monetizing it with revenues in the future. That's just, it's out there. It may or may not happen. So there are companies that fall into each of those categories. Luckily, this is not mainstream AI. So mainstream AI where I don't see a bubble. So the first thought there are your hyperscalers, right? So that's so these are the ones who are spending the most on AI infrastructure. And these are what are they? There are four that just are on everybody's mind. Microsoft, Amazon, Google, and God, I know it's Meta, but I just keep thinking of them as Facebook.
Yeah.
So, so your hyperscalers here, right? They all the spending they're doing, they're able to support it from fundamentals. They have operating cash flow. These are hugely successful, highly profitable companies whose existing earning streams are not at risk or about to disappear from that cash flow. They're spending for the future. And look, some of that may be excessive, but I can't bring myself to think that all AI spending is going to come to a naught, it is going to come to zero, and that this is just going to explode and fall apart. So I believe we are in the second or third inning of this AI revolution. And this, sadly, what happens in the stock market is well before it happens in real life. Stock prices anticipate the good future. And so you see prices go up before earnings or revenues change. And that makes investors very nervous. So I don't know if this is somewhat reassuring, but I don't see a broad-based AI bubble.
Okay. It's very reassuring, yes. And I see so many opportunities for application of this AI that have really yet to trickle down, in many different industries, but healthcare certainly.
Yeah.
And it's starting to in legal and a lot of
Yeah.
other fields.
Yeah. So, we think of economic sectors as verticals. So
Yeah.
AI, I suppose, would sit inside technology, but
Right.
not just AI, but all of technology is no longer a vertical. It has become a horizontal, right? It cuts through all other economic sectors. It cuts through all swaths of economic activity. And so, my goodness, the US healthcare system is so dysfunctional. It is so ripe for disruption. And really, I do think it's the tip of the iceberg. And just let's think, like, we're grappling, the world's population keeps going up, right? So 7 billion, 8 billion, one day we'll hit 10 billion. We don't have enough food, right? We have world hunger. We have diseases from which people die young. Imagine the computational power that AI brings to traditional R&D in these areas, and drug discoveries,
Yes.
in agriculture and food production. So there are
Yeah.
just so many good things that I think still lie ahead of us. For the life of me, I can't close my eyes and visualize what the world will look like 50 years from now,
Well, your optimism.
given the speed at which things are changing.
Yes, it's been tremendous. And your optimism it's very soothing. I like it
Uh,
personally. So we sort of just jumped right into the meat of the matter. Why don't we go back a bit? Can you just tell me a little bit about what you do in your firm?
oh my goodness, yeah. So this is the fourth stop in my career. You so kindly pointed out the Citigroup, Morgan Stanley, Vanguard experiences. Whittier Trust is a multi-family office. Heather, we are among the rare breed that we were formed sometime in the 1930s. So we are almost 100 years old. We began as a single family office for an ultra high net worth family. And then we have evolved into multi-family office uh, positioning. So we serve exclusively one clientele, the high net worth individual, and we are focused on preservation of the wealth they have accumulated, then its enhancement, and then more importantly, its transfer over multiple generations. So suddenly our time horizons, when we say long term, it's not 5, 10, or 15 years, it's 50, 60, 70 years. And we have clients and families that have stayed with us for that long. We have several multiple generational families with us. And that's only one aspect of wealth. That's just the money. That's the crass. I have money. Will somebody manage it? Yes, sure, we do that. But in addition, we provide all services related to wealth. So, estate planning strategies that help you with the tax mitigation and optimizing multi-period terminal after-tax wealth. We will do take care of all your philanthropy needs, offer family office services. So if a family has accumulated wealth and then simply want to enjoy life, we will take care of everything related to wealth. And I take a little bit of pride in saying that we want to make sure that the money is ready for future generations, but we take great pride in building such close connections with our clients that we also want to help them propagate and perpetuate their ideals, their values, their philosophies, because one day, I mean, biologically, right, there is a finite lifespan. And because we have existed for 100 years and we expect to for another 100, 200 or 300 years, we'll make sure that whatever the matriarch and patriarch found valuable or important gets memorialized, institutionalized, and then passed on to future generations. We'll get the money ready for the next generation. We'll get the next generation ready to receive the money.
It's very impressive. A cycle doesn't close with one person, it keeps
Keeps
going.
going.
And
Yeah,
yes, well, your success speaks for itself to have a multi-generational, you know, continuity. It's, yeah,
oh,
it's very,
thank you.
very, thank you for coming and sharing with us. So let's get back into the fun stuff. Um, let's start with equities. Where are equity valuations most attractive?
So we've had three incredibly strong years in the US stock market, 26%, 25, and 18% last year. And
Mhm.
so they ain't exactly cheap, Heather, right? Like the forward PE on the S&P 500 at the end of December was just right around 22 times. This is on forward earnings. So they're a touch pricey. Valuations are cheaper outside the US. Valuations are high in what we would call growth stocks. They are lower in value stocks. They're high in large cap. They're lower in small cap. And by the way, this dichotomy I'm describing, there's nothing new about it. That has been the case for the last 1, 2, 3, 5, 7 years. It's just that this cheapness just didn't matter. But because growth is going to pick up, in my mind, globally, so there was a bit of a slowdown. So there was a mid-cycle slowdown, and now I think we have a mid-cycle revival. And the hallmark of a recovery or a revival is that investors embrace risk. So they'll pay attention to the cheapness. And so I think this is now finally the time for international stocks to do well, value stocks to do well, cyclical stocks to do well, small cap to do well, lower quality, higher beta, or higher risk. Now, these are the way I describe them, they're not very conducive to building long term wealth for 50 years, right? Cyclical stocks go up and down in cycles. So you end up having to trade them. So, given our inherent philosophy is to look for long term wealth compounders, we will still look for opportunities because I mean what I'm describing essentially I described the broadening of the US recovery, the economic recovery. So not just AI like last year, but AI, fiscal stimulus, lower interest rates and deregulation. We're similarly seeing a broadening of the global stock market. So all the action is not just in the US, not just in mega cap tech, not just in the Magnificent Seven. You will find opportunities elsewhere, and we are selectively looking for them.
Okay. And when you say globally, or can you give a little more granularity?
Yeah. So we're building the most diversified portfolio we possibly can. So I think of the world, there is, of course, the globe is your kind of sandbox. Then we think of public markets, we think of private markets. So you
Mhm.
have stocks and bonds in different regions, and then we'll assess those opportunities. And then we look for private equity, private debt, hedge fund, multi-strategy, absolute outside managers who also have a similar global focus. I drive the asset allocation from my seat here at Whittier. Every portfolio is highly customized for each client. Uh, for the outside managers, we look for best of breed. In the public markets, um, Again, so the job now is with this broadening, where outside the US, right? Does China have strong enough fundamentals? We know they'll have kind of the state support. But again, we also want to own stocks for 20, 30, 40 years. So does that fit that profile? We're intrigued with South Korea. That's a direct play on AI extension. It began with extremely low valuations. I don't know how many people are aware of it, but it's literally doubled in the last 1 year and yet fairly cheap. So there might be some opportunities there. I'll refrain from kind of too many details because we're still rebalancing the portfolio and making our trades. But just so it's just, it need not just be tech. We're thinking of industrials. We're thinking of Europe because Europe has that big industrial base that'll help automation and robotics. So they are a strong ally, and we keep testing that alliance every week with conversations about tariff and Greenland. But so there are some really interesting opportunities as AI gains traction, and they're not just for the first time only in the US, only in large cap, only in tech, only in AI.
Okay, so I don't know if I have time for one, at least one last question. What emerging trends are you most excited about?
So the world is getting more complex. These technologies that have the potential to win big are more complex. And so I think complexity in investment solutions that an asset manager may provide, this is not for the sake of pursuing complexity, just because it's intellectually more satisfying or gratifying, but it is almost going to become a necessity. So the easy money in plain vanilla public market, basic ideas will quickly get squeezed out. And I think the big winners, the big asset owners, investors, and asset managers that win will be those who can think of a complex world clearly enough to provide complex, profitable investment solutions. Did we snake in the time limit?
Yes, I think so. So,
Okay,
thank you so
awesome.
much. This was a
Well,
pleasure speaking with
thank you
you.
for having me.
Thank you for sharing your knowledge.
See
Appreciate it.
ya.